Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The New York exchanges had a meltdown. Ross believes there will be some upward bounces, but you had better be on your toes. He comments on gold and the U.S. and Canadian dollars. InsideTrackTrading.com President Eric Hadik tells us about the cycles that keep popping up in the stock market and affect interest rates, inflation, food, and energy. Ray Merriman, publisher of Merriman Market Analyst on MMAcycles.com, talks about how the planet's sun and the stock market have a correlation. He tells us what the planetary cycles indicate will happen with inflation, elections, and cryptocurrencies. Plus, at the end of the show, we'll have a company showcase update from American Manganese President and CEO Larry Reaugh and American Manganese CTO Zarko Meseldzija. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money, Ross.
Pleasure to be with you, Jim.
Ross, quite a market meltdown this week. We didn't have that bounce back that we saw at the end of last week.
No, well, they tried to do it at the very tail end on Friday there, midday Friday we were down a bundle, and, but, even with, a little bit of, buoyancy in the last hour or so, we still got 7 weeks down as far as the market is concerned, and, overall, this thing has started, to be led off the top by the real speculative items really starting back in November when things rolled over, and we've just taken our time for everything else. Here's the we've got the S&P. If we take a look at the panic low back with COVID and March of 2020, we've now retraced 38% of that rally from that low. Targeting that we've been doing, still looking for maybe a 50% correction, which would be around the 3,500 level on the S&P, and it's currently sitting at 3,900. So on the short term, though, we've got things like the Dow theory. Finally got both the Dow industrials and the transports to take out important supporting lows, so that historically those kind of sell signals have produced ongoing move to the downside, but you don't look at it on a day-by-day basis. Clearly the action will continue to the lower side, but the bounces will be out there. There's very little doubt about that. But I don't think the major bottoms are in place. We take a look at things like the put-call ratio. There's not an overabundance of puts being bought versus calls. We've got about maybe 15% of the S&P stocks are below their 50-day moving average. If that gets down more towards the 10% level, we could be looking at an important low.
Now, has gold reacted to this in any way?
Gold has been very, very stable. We got a good oversold signal on the weekly chart on gold a week ago, and it held its own. Silver had a bit more downside pressure testing support, but the gold market really looks as though it's got the chance to retrace a pretty good amount of from that high that we had 2 months ago, when everybody was very initially concerned about Ukraine and the Russians. Now, we know that situation still exists, but the market has corrected enough. And, what is typical after times of crisis anywhere in the world, you tend to get those big reactions to the upside like we saw in gold and silver. And then you need a big correction where the relative strength index gets down around 30 or under to just clean out the weak longs. That is now in place, so I think we've got a reasonable chance here for the gold market to bounce. If you take a look at sort of relationships out here, the U.S. dollar topped out about a week and a half ago, and the weekly and monthly charts have got good sell signals. The daily is just sitting just above a key support area right now. So if we start to take out that support, could be a decent correction in the dollar index, which on the other side of the coin would be positive for the gold market.
Canadian dollar, how's it reacting to these high crude prices?
Well, it's we've gone we lost that relationship a while back, and the Canadian had a decent week this week, but we take a look at it overall, we're at just under 78 cents as far as the dollar is concerned, and the support during the year has been right here at 78. The resistance is up at 80. So we've taken out the initial support at the 78, run down to about 76 and a half, and had a bounce. So for all that we've got crude oil pretty stable up in this 110 to 112 range, we're not seeing any resiliency as far as the Canadian dollar is concerned. And when you look at wheat and corn, on the commodity side, on the agricultural side, those commodities are staying strong. So the Canadian, at this point, for all that it's got a bounce in this last week, I think it still has a downside bias.
Ross, thank you so much for chatting with us.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. Welcome back to This Week in Money, Eric.
Oh, well, thanks for having me back, Jim.
Eric, for newcomers to yourself and perhaps the show, can you just tell us a little bit about InsideTrackTrading.com and why Inside is spelt with two I's in the middle?
Well, I'll answer that second question first.
Yeah.
The Inside was originally an acronym, still is, but that's how it was how it originated. And each letter stood for a sector of the futures markets that were a focus of our analysis and trading strategies. And that's what, as a whole, Inside Track Trading is a educational and advisory and trading company focused first and foremost on the futures markets, but also on a lot of the overall indexes and cash vehicles. And we provide analysis, both cyclical and technical, on those markets, and as well as accompanying trading strategies, and trying to also hold true to that idea of give a man a fish, he eats for a day, teach a man to fish, And so trying to make it educational and so that our readers, our subscribers can also take what we're discussing and apply it to their own portfolios, their own trading approach, and hopefully be able to benefit from that.
Eric, for the stock market, you entered this year forecasting a multi-month top in January and another in September, October. Now that the January top is in the books, what should we expect from the next cycle high?
Well, as I was discussing leading into this year, I see 2022 as a major transition year, and there's a lot of reasons for that. Some of them generational in nature. I know that for years, when we were talking, I would often refer to the 40-year cycle and the unique repetition that it had shown in kind of currency, financial, economic market, going back to the origin, the beginning of the United States, and even before then, where on this recurring 40-year cycle basis, and it was usually from the 6th year of the preceding or culminating decade through the 1 year of the following decade. So in this most recent case, from 2016 to 2021, was when you saw these major shifts. And going back to 1976 to 1981, 1936 to 1941, and you just keep going back all the way to 1776 to 1781. That 40-year cycle has timed such monumental shifts, and one of the things I was talking about from a very broad perspective during that whole time was a culminating type of thing in stocks in a lot of sectors, and that there were all these other cycles coming into play that were anticipating a series of tops in 2021, early 2022, and then a final one, which I would expect to be very divergent, meaning that only a few stocks and indices might make it to new highs, whereas a lot of others would set lower highs out in that September-October time frame. But as you kind of got back down to just the most recent few years, the equity markets have had a very consistent 16-month cycle and the half cycle of that, an 8-month cycle, that have timed most of the real key turning points. And so coming into this year, I was explaining how a lot of the lead indexes and lead stocks had already set major peaks back in mid-2021, and May 2021 was the last phase of both that 8-month and 16-month cycle, and that I expected to see early January time an even more divergent top, where you would only see a couple of indexes and a few key stocks be able to spike to new highs, but most of them would be setting lower highs, and that would kind of open up the floodgates of selling for a few months. And so we've seen that unfold, and we're now right at the midpoint of that 8-month cycle, which when you're getting to this phase, and I don't want to get too confusing with your listeners here, but when you've got something like an 8-month cycle and you're getting to the a series of tops at the end of broader cycles, the in-between action will usually go for at least half of that cycle. So in this case, an 8-month cycle, you expect at least a 4-month decline, could be as much as a 5 to 5.5 month decline, and that will actually help determine what's to be expected from the next cycle high in September, October. All that to say that there was just such synergy of cycles coming into play at the beginning of this year. I had also, for years, I've talked about this 3.25-year cycle that was getting ready to invert and should time a top in January of 2022. The last time that cycle came into play was the fourth quarter of 2018 when it timed the bottom. Prior to that was mid-2015 or third quarter 2015 when it timed another bottom, and you keep going back and see this sequence of this 3.25-year cycle, and it was time for it to invert. So it was the synergy of all of these that really had me expecting early January to be a critical top in the market. And I also think that September-October time frame could be almost as critical and decisive as what we just saw in early January. What I would expect between now and then is probably a pretty wide trading range and some volatile trading between what I expect to be lows in here in the mid-May period and those highs in January. So seeing a couple of good solid multi-week advances and probably some quick sharp pullbacks, but stocks staying in a trading range as they begin to shift focus to that September-October time frame, when I think we're going to see another topping sequence and then another pretty dangerous period after that.
How does inflation and rising interest rates play into that?
Well, they have certainly been one of the drivers in the recent sell-offs. I don't think that they were the initial triggers, but you often get this where the prevailing fundamental doesn't really kick in until about halfway through a trend or a cycle, which is why I am such a firm believer in technical and cyclical analysis, because it gives you timing and it often leads these turning points as opposed to really following them. When, we started to get really on the higher interest rate bandwagon, many stocks had already seen some pretty serious sell-off. Same thing with the really heightened inflation fears. You had it creeping up last year, started to take a little bit more of the focus and the headlines. So they were certainly contributing factors, and I think that they are going to play a part in even this next cycle top. One of my intermediate to longer term bits of analysis dealt with inflation, and I'm speaking about commodity price inflation. Exactly where that filters down to CPI and PPI, especially when they half the time want to pull it out and act like it doesn't even play a role in everyone's day-to-day living. I'm focused on commodity indexes, specific commodities as a whole, and my outlook has been for a 2.5-year uptrend from April 2020 through September, October of 2022. That still is what my work is showing. So I think we're going to see a bit more of the commodity inflation between now and September, October time frame. And often you have something like that being the straw that breaks the camel's back, so to speak. You might get commodity price inflation and stocks, which is really paper vehicle inflation. You might get them topping within a couple weeks of each other or even closer together, but as you've seen at many major turning points along the way, the one leads and often causes the sell-off in the other. So we may get another type of event. The most recent event that really kicked it up was the Russia invasion of Ukraine and what that did to energy prices, grain prices, and you just had another surge in commodity inflation. You may get another trigger in August, September of this year that creates another spike high in commodity inflation, and that might be the final straw where even if stocks have recovered at that point, now you get more fears of inflation, of higher interest rates, and all of a sudden you get a sharper sell-off in the stock market. And then, because the stock market's selling off and all of a sudden your stock traders are starting to get deflationary fears in their mind, then all of a sudden the commodity inflation peak follows very close behind. And so if you're, a historian looking back, you're thinking, the two topped within, a couple weeks of each other. But really they had such a opposing impact on each other, and then a correlating impact on each other, with one triggering the sharp sell-off and then the other following behind. You've seen that so many times, and I wouldn't be surprised to see something like that later this year.
Last year, your newsletter was saying that gold needed to make one more new high to complete a fifth wave rally. What does that mean in technical terms, and has gold fulfilled that?
Gold has definitely fulfilled the minimum upside objective for that. And by minimum upside objective, a fifth wave in Elliott wave terms just needs to exceed the peak of the third wave in order to really validate itself as a fifth wave. And that third wave peak that I'm referring to was the August 2020 high in gold. That came right around 2080 on the lead futures contract, 2080 an ounce. And so gold was, throughout the early part of this year, I explained why I thought that gold should see a strong rally into late February, early March, and why the final weeks of that would likely be another application of what I call the 90-10 rule of cycles that's particularly predominant in markets like gold and silver, where you often see the majority of a price move at the very end of a cycle. And the Russia invasion of Ukraine just played perfectly into that outlook, since late September, early October, when gold and silver and the mining shares had set 6 to 12 month lows. This had been the outlook, and the focus had been on late February, early March for that accelerated rally into a peak. And sure enough, the February 24th attack is what triggered gold and silver to surge into, 2 weeks later, they had peaked. And even though that fundamental continues to go on, the markets are always anticipating things well in advance. So gold and silver were just finishing their upcycle at that time, and gold did just what it needed. It spiked above that 2080 level and initially fulfilled that fifth wave criteria. The reason that I mentioned minimum and initial is that from just a purely Elliott wave standpoint, you don't know for certain if the fifth wave peak is intact until the market has broken down below the previous major low. So in this case, that would be that late September, early October low. In gold, it even had a similar low, kind of a double bottom, in March of 2021, and then late September. Both times it was around the 1680 level. Well, until gold breaks below that, you can't really say that the fifth wave is complete, because it could see the kind of sell-off we've just seen and then still work its way back up and maybe barely make another spike high, and extend that fifth wave. And that is why I use a lot of other indicators and cycles and risk management tools to bring that broad general outlook and analysis to more specific, more practical, more pragmatic approach to the market. So there are many things that were certainly saying gold and silver should set a multi-week and possibly multi-month top in that early March time frame, but they too have a second cycle high in 2022 that comes into play in August or September, and where another multi-month peak is expected. And there are a couple of key technical indicators I use to help me determine whether I think that future high is going to be higher or lower than the previous high. And right now, gold is still leaving open the chance for higher highs later this year, but the next week or two could alter that, depending on whether or not this indicator it turns negative completely or not. And I won't really know that until this weekly close on May 20th, and then even the following weekly close on May 27th. So there's some indicators that I'm going to be watching very closely to see if gold confirms in my work that a major top is intact, or if it leaves open that opportunity for slight new highs later on in the year.
In recent years, you've talked about long-term food crisis cycles colliding in 2020, 2022. Have they been fulfilled, or is there more trouble ahead?
I guess the answer would be yes to both of those. They are certainly being fulfilled. That also was in the context of this very broad 40-year cycle that I've discussed and have a whole website built around just that, 40yearcycle.com. And one of the things, in addition to economic and currency battles and stock market movement, one of the additional things had to do with major food crises, famines, crop shortages, and sometimes that was strictly natural caused or based, and other times it was very governmental based. When you talk about some of the things like Russian and Soviet famines in the past, and other things like or where war really triggered serious famine, and so it's a mix of both natural or climate and human involved geopolitical forces, but it has stayed and recurred on this 40-year cycle basis. And, just the last couple sequences of it, well, even you can go all the way back to the the mid-18 teens through 1820, and you had the eruption of Tambora that created freezing temperatures, almost non-existent summer. The following year, in 1816, often dubbed the year without a summer. There were actually several other volcanoes that had been erupting prior to that and then subsequent to that also contributed to the cooling effect of all that volcanic activity. But that created its own food shortages, crop shortages, and each 40 years you have similar type of results, even though the causes are much different. In the mid-30s to the early 1940s, you had the Dust Bowl throughout the U.S. and the impact that had. And 40 years later, 1976 to 1980, 81, it was more of a economic dollar inflationary, and then embargoes in there and even serious drought in California back in 76, 77. There were all these factors coming together again, and each time it's almost always a synergy of many factors that create enough of a force to really perpetuate this 40-year cycle. And so my outlook was to see these forces start building up in 2016 to 2019 to 2020, and the way that my analysis in the individual grain markets and soybeans, corn, wheat, a lot of other commodities, that was showing that they should see the real effects of that developing food crisis cycle. They should have their big moves in 2019 through 2022, maybe stretching into 2023. And here again, we've seen a collection and a sequence of different drivers, with the most recent one being Russia and Ukraine. A year and a half ago, or 2 years ago, it was one of the big things was China trade policy and their commitment to buy so much in soybeans, and not that creates the type of food crisis you normally think of when you're talking about some of these famines and Dust Bowl and that, but all of a sudden demand starts outstripping supply, and that's all it takes to get the market reflecting some sort of food crisis. And now you've got the breadbasket of Europe in jeopardy of not being able to get all of its wheat crop to market and to Europe, Africa, and around the world. So you don't necessarily, most times you don't know what the driving factor is going to be, but cycles and the technical indicators and these markets tell you long in advance when these events are a much higher probability. So I do think that this food crisis is ongoing. I think there's going to be different factors factors that keep perpetuating it. Even now as energy prices continue to stay at such high levels, that's going to filter down to the cost and the supply of different crops. And as you have, the labor shortages continue and other inflationary factors, there's just all these different contributing and exacerbating factors that end up fulfilling these cycles. So I do think there is still some more left in that food crisis cycle, and that also kind of dovetails with commodity inflation cycles I was talking about, where I think that the final peak, final surge in this 2 to 3 year cycle is probably going to be seen in September, October of this year.
How does this fit with your discussions on sunspot cycles? Is there a connection?
I think there's very definitely a connection, and just because I say, let me step back and go to that other adage of, correlation, not necessarily causality, that because I think that there is a close link and coincidence, synchronicity between them, doesn't always mean that one is creating the other, but I do think there are a fair amount of factors why solar cycles do play a role, particularly when we're talking about things like food crises and natural cycles and events. And I've said since the late 20-teens that I thought that this next solar cycle, which took hold in December 2019, is when they really kind of timed the bottom of solar cycle 24 and the onset of 25. I thought that this one would be a lot more surprising. Most of your the scientists that deal with that were forecasting another very subdued solar cycle, just like the previous one. Things are so often extrapolated out on a linear basis, and that's not what cycles are. In fact, cycles are the exact opposite of that. That you have the ebb and flow, you have the acceleration into peaks and acceleration into lows, and so just because something has happened during one phase doesn't mean you can extrapolate that out on a linear basis. And a lot of my longer-term cycles, going back decades, centuries, I compile a lot of this leading into 2019, 2020 and continue to talk about it, where I think this was going to be and is going to be a far more dangerous solar sunspot cycle. And my cycles have been focused on 2022, 2023 as the greatest synergy, the collision of all of those cycles, and the greatest synergy even within that 2-year period is in 2023, where I think from a cyclic basis, and again, I'm not a scientist, I'm not an astronomer, I don't study the sun per se, but from my cyclic work, I think 2023 has the greatest probability for at least one, perhaps multiple damaging solar storms. And I don't know what that means. I don't know how much we've learned and built defenses in everything from electrical grid to satellites to you name it. I don't know how much we have prepared for that and are able to withstand it. All my work is doing is showing when there's a higher probability of these things occurring. So I do think that solar cycles have a very definite coincidence and some causality on these other cycles.
Right. What you'd be referring to is something similar to the Carrington event, where solar flares back in 1859 knocked out the entire telegraph system. In some cases, they melted down or caught fire. But of course, telegraphs were the only electrical infrastructure the Earth had at the time. We have a whole lot more connected to the grid now.
Absolutely. And really, the satellites are probably one of the most at risk. And, they have certain defenses built in there, but there's also certain vulnerabilities that you hear discussed every once in a while. And with pretty much everything in our society linked somewhere along the line with satellites. You've got some high vulnerabilities there. Like you said, during the Carrington event, there were even instances where they said that, the stations where, someone would be in handling the transmission and reception of these telegraph messages, where the entire board just blew up in flames. That was the burst of electromagnetic waves that pulsated through the whole system. But you don't have to, I think often it's easy for people to say, oh yeah, that was, 160 years ago. We're much different, more evolved than that now. Well, all you have to do is look at the last 50 years. And you can go back to the superstorm in, I believe it was like 1972. But then after that, in 1989, the Quebec storm that knocked out power through a good part of Quebec. And it was only due to a few kind of minor buffer stations between Canada, the northern U.S., and the whole east coast of the U.S. It was only the fact that those few buffer stations kind of held up with the surge that occurred, that the entire east coast didn't go blacked out from that solar storm. So just because dramatic things, or as dramatic as they could have been, didn't happen, doesn't mean we didn't get very close. And you had other storms in the early 2000s, the Bastille Day storm, there are a couple others. But the one that really caught my attention, and most people are completely ignorant of it for normal reasons, but was one that occurred in 2012. And from all accounts, from all measurements that they could make, that storm was as powerful, if not more powerful, than the Carrington event. The only thing that saved Earth was 9 days of rotation. That when that storm erupted and the sun sent out those CMEs and the burst of electromagnetivity, it wasn't targeted right at the Earth. So it went hurtling out into space. Had that happened 9 days earlier, I believe was the case, 9 days earlier, you would have been talking about a storm hitting Earth that at least had the magnitude of the Carrington event. Whatever the results are, again, I can't tell you. That's, way above my pay grade as to what we're able to handle and withstand and what we're not. But these storms are a recurring phenomenon, and recognizing and discussing them doesn't, mean you're Chicken Little or an alarmist. It's just, I take the Patrick Henry approach. I'm prepared to know the worst and to prepare for it, rather than listening to the song of the siren till she transforms us into beasts. And the whole rest of Patrick Henry's great speech back in the 1770s. And so discussing and researching and at least being aware of these possibilities, I think is critical. Now, overreacting to them and taking a complete alarmist approach can be just as damaging as sticking your head in the sand. So I want to discuss them and really examine them and see where there might be vulnerabilities, where there might be things even in your own personal life and investments and everything else to prepare, but not to overreact to it either.
Since early 2020, you've talked about a major uptrend in natural gas that should last at least 2 years and reach a pair of key targets. Has natural gas completed that move, or is there more to come?
Well, ever since there was just a strong convergence of cycles back in the first and second quarter of 2020, and my work started generating long-term buy signals between $1.60 and $2 in the natural gas market, and those long-term buy signals are still in effect, but from a multi-year basis, there were two key upside targets for natural gas, one being at 850 to 840 to 850, which we've actually just hit. And then there's a second one beyond that I've been starting to discuss in my newsletter. But the fact that we have hit that first one is certainly a place where you sometimes see some consolidation, but my cycle outlook is still showing that there's a chance for higher highs lasting into that same commodity inflation and grains, and those cycles also apply to the energy markets, to natural gas, even though the cycles are derived from very different and distinct factors and turning points. It's the fact that these somewhat correlated and somewhat non-correlated events are all pointing to the same time frame. That's what really catches my attention a lot when you have that type of synergy, particularly when there's a high level of non-correlation between the markets or the cycles or the events coming into play that are all focused on a specific time frame. And so I think that natural gas could still see another leg up and could still reach higher levels later this year. Right now, I do think that there's going to be some consolidation after hitting that 850 level, and it's got some support at around 650, so it wouldn't surprise me to see some trading in between those two levels for a little while.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim. It's my pleasure.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. He was speaking to us from Central California. Coming up, Ray Merriman next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Ray Merriman, founder of Merriman Market Analyst and the author of several books on the correlation between market cycles and planetary cycles. His website, MMAcycles.com. He's speaking to us from Scottsdale, Arizona. Ray, welcome back to This Week in Money.
Thank you, Jim. Good to be with you again.
The Merriman Market Analyst is now into year 40. Can you tell us a bit about the letter and how people can subscribe? And how did you get started doing it?
Well, good. I'll be glad to tell you about that. So the MA Cycles report is a monthly report, started in 1982. So you're correct. It's a 40th year publication. And, well, it started when Walter Bressert, who was the director of Foundation of Cycles and a well-known commodity analyst himself in Tucson, asked me if I would do a research on gold, because he had observed that whenever Mars goes retrograde, changes directions, gold had always made the higher of the low of the year those two times, and it happens every 2 years. And sure enough, within a couple of days, that was the high and low of the year for those periods of time since gold had been trading. So he wanted to know if there was other correlations with astrology, if you will, that might be as useful as Mars retrograde at that time. So he told me he would teach me, and he did, about cycles if I would do that research. So I went to all his courses on cycles and technical analysis, did my research by going back in the history of the gold market, and identified 17 correlations that did have a high rate of frequency to highs and lows in gold. So I started with a gold letter, then it became a gold and silver letter, then it became a stock market gold and silver letter. So that's how it evolved over that time. So it's a market timing letter based on my research of rhythmic cycles in financial markets. So that is, I've identified time bands with orbs where 80% or more cycles have unfolded in various markets going back many years. Bressert did that with a 4-year cycle, did with a primary cycle and a half primary. I identified a few other cycles that have a 80% correlation with specific time bands. And I went back to 1792 when the U.S. stock market started trading and identified all of these long-term, starting with a 72-year cycle, 36-year cycle, 18, they're all harmonics of 18 years, and all the way down to the 6-week cycle, which I call a major cycle. So, Jim, these long-term cycles that I've identified are very valuable for investors who like to buy and hold for several years, say 5 to 20 years. But they don't want to buy at the top of a market, you know, and so many people do. Most people buy at the top of the market. But if you can identify 4-year cycles or greater, you can save yourself 20% or more. You know, if you wait till that cycle bottoms and time your long-term investments in. And the same holds true with short-term traders, okay, which is most of my clients. This information, this study is very valuable to short-term traders. And as I say, that's most of our subscribers. So we identify time bands of those cycles that have rates of frequency exceeding 80%, that are primary cycles or less, which means 15 to 21 week cycles and their phases, which means 9 to 10 week cycles, 5 to 6 week cycles, 2 to 4 week cycles. We identify them because when we get those time bands, we then look and see, is there any geocosmic signatures going on at the same time that will narrow that time band down from 6 weeks or 3 weeks or 2 weeks down to a day. And then we give it a 3-day orb. So we provide a time band as a leading indicator for readers to prepare to enter and exit markets. These are leading indicators. And then we get that time band, then we try to, we calculate what the price targets are for normal corrections or, price thrusts, if you will. So we identify price targets, and we get that price target in a time band for a cycle reversal. We want to see that there's a technical indicator that's overbought or oversold. We like to see a chart pattern that supports the direction we want to go into, and then we issue our buy or sell signals. And that's what we do in the monthly report, which is our biggest subscription report, our weekly report, and our daily report. And we're also, you know, it's not just the U.S. stock market. We have reports that deal with the Chinese market, German market, Swiss market, Japanese market. We cover gold, silver, Bitcoin, Ethereum, currencies like the euro, Swiss franc, and Japanese yen, crude oil, tea notes, and soybeans. Those are the markets we cover.
What is the Merriman Market Analyst Academy?
Well, it's the MMTA, the Merriman Market Timing Academy.
Mm-hmm.
So this is a 2-year program, a learning program, where we offer students live webinars 26 times per year to learn our methods of market timing, investing, and trading. So we're actually developing to be good market analysts, but also traders, if that's where their skill and their interests lie. So there's 8 courses. Each contains 12 to 18 classes, about 100 classes in all, and they run for 6 to 8 weeks at a time, 2 hours each on a Saturday, followed by a 1-month break. And after each course, the student is tested on the material to make sure they understand it. They got to pass the test. And then they're also required to do a research paper on that material. And we got to approve that research paper. So it's a very vigorous, intense learning. Now the graduates, those who graduate, we feel if they really have the temperament for it, they're ready to trade. Or in most cases, they're ready to at least become analysts in their own rights. And several of these graduates end up working for other firms or themselves, or in many cases we hire them. They provide analysis for different markets in our reports that we offer our subscribers. Now, the class I have right now that's going to end, it's going to end in September. They've been with me since January of last 2021. And it's quite amazing. There's 45 students still. Usually we lose about half of them because it's too rigorous. But we started out with 50 and we still have 45. And they're going to see it till the end. And they're going to be graduating. We have a graduation ceremony at the Michigan State University Educational Center in Troy, Michigan, September 9th to 11th. And that's also going to be part of our MMA investment retreat. We have an investment retreat every 2 years. We skipped the last one because of COVID. But we're going to have our investment retreat that same week. And at the end of that, we're going to, give the graduation certificates to those who spent the last 2 years studying with us. And the next MMTA program is going to start March of 2023, and that again will last for 2 years. So it's a very intense educational program, and when students come into that, they realize pretty quickly that they don't know what they thought they knew. And what they're going to learn is completely different than what they expected to learn. And they become pretty good analysts after that. In fact, from the first course we had, we're number 2 now. The first time we presented this in 2014 and 15, I would say half the people who graduated are in the industries doing something, and 5 or 6 of them are working for us right now. So it's a pretty amazing program that we got, and it's myself and some of the graduates are teaching it with me, and they do a very, very good job. So I'm very proud of them.
Ray, some people call what you do financial astrology, but you prefer to use a different term, and can you tell us why?
Well, financial astrology is a little bit misleading because, when you say financial astrology, you're dealing with the astrology of money, which can be many things. It can be how do you save money, not just, stock market or financial markets. What I'm looking at is using astrology or geocosmic studies, because we're not really that interested in constellations. We're interested in mathematical relationships between planets. We call them geocosmic studies. When 2 planets come into a conjunction or an opposition with each other or a quarter cycle, these are very useful timing mechanisms, and markets turn within about 3 days if under certain types of these combinations. So I prefer to call it geocosmic studies, and you can call it financial astrology to some extent, but it's more like financial market timing, using astrology or using geocosmic studies. I think that's more accurate to what I do.
Mm-hmm. So what do you see ahead in geocosmics for inflation and interest rates?
Well, I think the rate of inflation is peaking now that Jupiter has passed its conjunction to Neptune. That happens every 14 years. So that aspect is passing, and it's moving out of the sign of Pisces, which is also inflationary, and going to Aries. Doesn't mean inflation's going to go down to 0, but it does indicate the rate of inflation has probably peaked. We're not going to get it jumping from 5% to 8% a month. It's going to be leveling off and maybe even declining more toward, I would say, back toward 4% within the next year. So I think inflation is going down, but it's not ending, and I think it'll go down for a couple of years, maybe even until the middle of the decade. I think it will come back again the next decade, even stronger than we saw this time. But the thing is, the interest rates, I think the raising of the interest rates is going to have an impact. The tightening of liquidity by going to quantitative tightening instead of quantitative easing is going to have an impact. And that concerns me very much, because even as interest rates are rising, I think inflation is going to come down anyway, and I don't think it's necessary to really sell all the securities in the portfolio of the Federal Reserve Board. I think that's going to lead us into a recession. I would prefer, and this is as somebody just studies the markets, not necessarily an astrologer, but I would prefer to see the Fed Reserve just let those maturities expire and, just let them, come to expiration, and just don't rebuy them, as opposed to actually going to market and selling them. I think that's going to exasperate and quicken a recession, even by the end of this year. So the astrology part tells me the inflation is going to moderate. It's going to start coming down. I don't think it's going down below 4%. But interest rates will continue to go up. I don't think they're going to be as aggressive as the Fed is leading us to believe, because I think they are going to recognize that, hey, inflation's coming down and we're going into a recession. And, I think they're going to walk back some of their hawkish rhetoric about quantitative tightening. I think they're going to kind of listen. They're kind of going to tune into what I'm suggesting here, that maybe they don't have to sell those securities. They can just let them mature.
Could the stock market be in for a summer rally?
Well, nothing's a given, but this is one of those 80% rate of frequency cases where a 2 to 6 month rally is due from a low that would happen sometime between February and July. Okay? My biggest worry is that we already had that 2 to 6 month rally from the low of February 24th through the high of April 21st. That was 2 months, which is the shortest you would expect the rally to be. So if that's the case, we're in for a very, very dark winter. dark summer, dark winter. I think we'll be in a bear market for 15 to 24 months if that was the high. So if we keep going down I would say if we keep going down after next couple of weeks, if we keep making lows, if we get into June, July, I don't even think we have to get to August, but if we start making lows in June and July, that to me is a very, very bearish sign. That's not my bias, but it is a possibility. I'm more of the opinion that we're going to get a bottom in here. In fact, we might have just had it in the last week or so, or have it the next week. I think by the end of May, early June, we get a bottom, and we get that 2 to 6 month rally. And I don't think it's going to go necessarily 6 months. I'm thinking it would be done by September. So where are we now? May, we get to June, so we're 5 months away. I don't think the rally is going to go past September. But I think there's still a chance we'll get a rally, and it could be very robust and healthy.
What do you see as long-term possibilities for big gains in the stock market?
Well, if you're saying what would cause a big rally, I would say the end of the Ukraine war, with Ukraine defeating Russia. I think a rally would be huge if that happens. It'd open up all kinds of supply things with so many countries that are democratic, and they'll probably, leave many of them that have been on the fence would jump onto that, because what the world wants with Jupiter going into Aries is trade. They want to open up trade. They're tired of being, having tariffs and having disruptions of supplies, holding back their trading because of the war in Ukraine going. Jupiter in Aries wants to be bold. They want to speculate. They want to trade. And that's another reason I think we're going to get a rally at some point, this summer. But how high can it go? Well, let me give you an interesting statistic here. In the last 120, 130 years, every 4-year cycle, from the bottom to the top, I shouldn't say every, most of them, have rallied 70 to 189%. So the bottom was March 23rd, the pandemic bottom we had, and we have rallied between 70 and 189%. In fact, the average gain in the last 120 years for 4-year cycles has been 103.9%. Okay, 103.9% for the Dow Jones in that bottom we had would come up to 37,136. In January 5th, the all-time high was right there, 36,952. It was a gain of 102.9%. The average is 103.9, so it came within 1% of the average gain over the last 120 years. So I'm not convinced we're going to get a rally that's going to make a substantial new high. I think at the most it might go 1 to 2% above the high. But I'm more of the opinion that we're not even going to make a new high. We're just going to go up to within 1 to 2% of it and come back down. So that's the 2 to 5% rally I'm looking at. That's the big rally. On the other hand, there's a presidential cycle. Every Republican president since the Great Depression has overseen an all-time high in the U.S. stock market, meaning the Dow Jones Industrials. When a Democrat has been president, that has not been the case in 3 times. There's been 3 Democratic presidents that the market is not making a new high. That would be Franklin Roosevelt, Harry Truman, and Jimmy Carter. They did not make new all-time highs. Every other president's made an all-time high. On the other hand, no Democratic president has been in the White House since the Great Depression when we've had a crash, a stock market crash. No Democrats, no stock market crashes over 30% under Democratic president. There was a 50% decline under Franklin Roosevelt, but that wasn't the crash. The crash was the 80% under Herbert Hoover in 1929, who was a Republican. The other side of this is we've had 6 crashes since the Great Depression. Every one has been presided over by a Republican president. So it's interesting. When you get a Republican president, you always get an all-time high, and you have a higher probability of having a crash. Under Democratic president, you don't always get an all-time high, but you don't get a crash of over 30%. So what is this telling me? Well, the geocosmic cycles, especially the lunar nodal cycle, refers to a big decline somewhere between 2026 and 2029. That's the next presidential election cycle. That's when I think we're going to get over 30% decline in the Dow. If that's the case, that would indicate 2 things. One, we don't get a 30% decline before then, before the election, and Joe Biden's not our next president. A Republican be the president. And under that Republican, we'll get both a new all-time high and we'll have a stock market crash. So I think these are very interesting things to look at in the past and try to correlate them with cycles in the current times that we're dealing with.
Ray, you might have answered this. Does the presidential cycle related to stock market cycles tell us anything about the 2024 election and the 2020 election filled with fraud?
I think the answer is yes. I think the geocosmics and the stock market do tell us something about the election. As I said above, I think what I'm reading into this is that the Democrats will likely, I can't be 100%, I think the probability from my studies is like 80%, that the Democrats will not take the White House in 2024. The Republicans will. And there will be a crash, and there will be a recovery to a new high, or vice versa. They take it over and there's a new high shortly afterwards, and then we crash. Now, as far as the election fraud, I don't see anything that I understand in astrology really here regarding any change in the election outcome of 2020, or proof that the election fraud that there was election fraud and the election would be overturned. Now, I will say that former President Trump has been under a huge hard aspect from the transit of Neptune to his sun and moon. We call that a T-square. And in this study of astrology, Neptune implies one is under an enormous delusion and has succeeded in convincing his most ardent followers, which is another concept of a Neptune. You get groupies, people who follow you, into believing the narrative that somehow the election of 2020 will be overturned, or at least proven to be fraudulent. And I don't see that happening. I'm not suggesting there wasn't fraud in isolated cases. I think there's always fraud in elections in the United States. But I don't think it will be proven beyond a reasonable doubt, and I don't think they'll be able to have documentation that will convince the courts to overturn it. I think it's a waste of time chasing something that's not going to be overturned.
Do you see any surprises coming up in financial markets, like an October surprise, and does it relate to anything unusual going on in the cosmos?
Yeah, as a matter of fact, I do. In the study of astrology or geocosmic studies, Uranus is the planet of surprises and disruptions. And it's going to return to a hard aspect to Saturn in September and October of this year, especially the week of September 21st to 28th, because at that time, not only do you have Saturn coming back within a degree of its exact square to Uranus as we had in 2021, and it continued to the first week of 2022 when the stock market topped out. So not only do you have that aspect coming back, but right in the middle of that square is going to be Jupiter. It's going to be the midpoint of the Saturn-Uranus square, making a semi-square, which is also a hard aspect to each one. That's very unusual. You don't see that every day. In fact, you see that maybe, I don't know how often that happens. Not often. It doesn't happen more than every 45 years, really. So this tells me, because Jupiter represents the principle of exaggeration, Uranus represents the principle of disruption and possibly catastrophe or surprises at least, that we're going to get a huge rally into that time or a huge crash into that time. I wish I knew which one it is. If we had the 23-month cycle already bottom in February and already topped out in April, then I would say we're going to have a crash in September, October, and I might be a month off or so. So let's say August to November. I would say a crash. But if we continue to go higher and come within 2% of the highs in September, October, that could be the top. I mean, that could be a huge rally that takes us into the top then. And then maybe we come down. I don't think it's necessarily a crash, but I think we come down into the 4-year bottom, which is due in 15 to 24 months from now. So whatever it is, the geocosmic do say something if a surprise is happening, and it's going to be somewhere September, October, give or take a month, especially if you take that week, September 21st to 28th, and give that about 6 weeks. Something big, something surprising is showing up my radar where geocosmics are concerned.
What are you seeing ahead for gold?
Trouble. I think the 23.5-year cycle for gold topped out in August of 2020, and it made its double top in March 8th at 2078. And I think gold is going to now fall over 45% from those highs back to 1,200 or lower in 2023 to 2025. Now, I've been a big bull for gold since 2021, and especially since August of 2018. We just got out of all of that when gold went back up and tested 2,000 a few weeks ago. But I want my clients to stand aside for now until one or two things happen. Either it proves I'm wrong and gold goes over 2089, or it goes above 2100, in which case, okay, go back in. We missed $100 of it. Go back in. I don't think that's going to happen. What I want them to be more prepared for is wait 1 to 3 years for gold to go under 1200, then start buying and become very big bulls, because I think gold's going to go to a new all-time high, but it's not going to be the next all-time high. The next peak of the next big rally is going to be around 2040, give or take a couple years. So, I mean, you'll make new all-time highs before then, but it'll keep on going up in another bull market, I think, to 2040. So I'm bearish on gold for the next 1 to 3 years, but I'll be very bullish on gold once we get to 1200 or lower. And I'll be recommending people to jump back in and hold on for 15, 20 years in.
What are you seeing ahead for currencies, the U.S. dollar, and Bitcoin?
Okay, so the U.S. dollar could be having a pullback. It could have a 2 to 3 month pullback, just as gold could have a 2 to 3 month rally. You know, sometime between July and September, I think gold's going to have a good rally, $100 rally. And I think the dollar is going to pull back maybe 4 or 5%. But it's just a correction. It's a correction in a longer 15-month, 16-month cycle. And then the dollar is going to go higher. I think the dollar doesn't top out until January of 2025, because it tops out when a Democrat is president. The dollar is stronger. It goes down when a Republican's president. So therefore, I think it's going to continue up while Biden's president, Democrats hold the White House, until January 2025, give or take 6 months. And then a Republican will be elected, I believe, and I think that will correlate with the dollar going down as long as the Republicans in office, whether it's 4 years or 8 years. So I'm bullish on the dollar. I would recommend people buy the dollar, get invested in dollar on a correction, a 2 to 4 month correction. Just do it any time. Maybe it's already starting now. But then once you have that correction, 4 or 5%, I would buy the dollar again and hold it for 2 years. And the same thing with, the opposite with currencies. I would, you can maybe buy the euro now for a rally to maybe 112 to 116. And by the way, that comes from one of our top market analysts who went through our course, Ulrich Aspegren from Switzerland. Very good euro analyst. And he's calling for a rally to 112 to 116. I agree with him. It would last 2 to 5 months, and then it's going to go break par. We're going to see the euro break par for the first time, 20 years or something, and maybe even go down into the 80s. So that's my outlook for that. As far as Bitcoin, I think Bitcoin is in trouble too. You had a sell-off to 2,500, which was my minimum target, 25,000, I mean. We went to 25,000. We got 25,300. There's a possibility that was it, but I'm more of the opinion that Bitcoin is going to drop below 18,000, maybe even go down to those 5,000 sometime before the end of this year. So I'm bearish on Bitcoin unless it can get back above 45,000. I think it's going down to 5,000, 18,000. Then I would buy Bitcoin because I think it's going to make another big run after that. That'll be the end of the 4-year cycle, and I think you're going to make another run after that into 2023, 2024, maybe to new all-time highs again.
Are the geocosmic tea leaves predicting any potentially important upcoming events?
Yeah, September 21st to 28th. Give it 6 weeks either side, but something big is happening then. It's either, a huge move, a crash, or a huge rally in the stock market, other markets too, and it could be the turning point of the Russian-Ukraine war where we know who's going to win or who's going to lose, and who's going to lose. That's the turning point, I think, within 6 weeks, September 21st and 28th. That's big to me, and it's going to be big to the markets.
Can some markets be in sync with financial astrology while other markets are not?
Yes. For example, these major mathematical relationships, we call them aspects, between all planets, can correlate to a major reversal in some or all markets, depending on where that market is in its cycle. Okay? And certain planets have more relevance to certain markets than others. For example, Jupiter-Neptune combinations have remarkable affinity for major trend reversals in crude oil, but not so much in other markets. Jupiter and Uranus combinations have a powerful correlation to reversals in the stock markets, but not as much in other markets. Mars in Scorpio has a huge correlation to rallies in gold, but not in other markets. And any market that's in a time band for a cycle, trough, or crest can reverse when any of the outer planets are in major aspect to other planets. So it also depends on which markets are due for reversal when geocosmic turning points are present. If one market's not in time band for a cycle, top or bottom, and another market is, then the one market that's in the time band for a cycle, top or bottom, will reverse. The other one that's not in the time band for a cycle, top or bottom, won't reverse. They just go sideways or pause. So that's how it works.
How can people find out more about Merriman Market Analyst?
Well, they can just Google me, or they can go to our website, www.mmacycles.com. And every week I write a free weekly column that I post on our website. And I've discussed the geocosmic signatures that were in effect the last week, those coming up the next week or several months, and how they have related to financial markets in the past. I don't give recommendations. They're only in the subscription reports. But I'll indicate, what relationships, what aspects have had relationships in the past that are coming up and which markets they affect. And also how those aspects affect socio-political, economic matters. The column is free, and if you request it through our website, we'll send it directly to you, so you don't have to go to our website every week to read it. We'll just send it to you in an email blast that we send every week to those who want to get it by email every week. And that way you can view what we're thinking every week coming up and what we thought about the last week and how it was impacted by geocosmics. So everybody's welcome to do that, and I encourage anybody who's interested in this material to go to mmacycles.com and sign up. Give us your email, and we'll send you that free weekly column every week. Or if you want, just go to the website and read it. Either way is fine with us.
Ray, thank you so much for being on This Week in Money.
You're welcome. Thank you, Jim. Pleasure to be with you.
My guest has been Ray Merriman, publisher of Merriman Market Analyst on MMAcycles.com. He was speaking to us from Scottsdale, Arizona. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Ray Merriman, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh and American Manganese CTO Zarko Meseldzija. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. My guests are CEO and President of American Manganese Larry Reaugh and American Manganese Chief Technical Officer Zarko Meseldzija. First of all, we're going to talk with Larry. How are things going in the markets for you?
Well, just before I get into that, Jim, I'd like to mention that I've been ill for a few weeks now, but I can tell everybody that I'm getting stronger and better, and I'm still working from home, but there's no big reason for concern in that regard. And then I'd like to talk about the market. The market's a very strange duck at this time. I mean, you've got all kinds of reasons for it to go into the toilet, but it hasn't. And after doing a lot of studying on it, I figured that the biggest detriment out there is inflation, and that's growing at trillions of dollars around the world. And you would think that that would have a negative effect, but it really doesn't. It actually has a positive effect. With all that money sloshing around, you're seeing a lot of stocks that are maintaining, going up, and that's because of the printing of money. There's no doubt about it that money is sloshing around in the market, and it's certainly been a benefit to a lot of companies, especially in the EV battery and EV manufacturing, and actually the EV space totally. So, I see that sloshing of money being a positive, and I don't see it going away for a while. And I know it's hard to grasp on that. I mean, you got several percent inflation going on, and printing of trillions of dollars of money around the world, and yet here I am saying it's bullish for the market, and it is. It's a kind of a new way of looking at things with that money all sloshing around, going into various areas, and certainly recycling is one of them. So I just want everybody to know that they can thank inflation for the actually negating the total collapse of the market. So I think we're in good shape, Jim. I think we're in good shape coming up, and there's not a lot more that I can say about that unless you guys have some questions.
Zarko, what's the latest news release from American Manganese?
Yeah, maybe before that, I'll just kind of quickly add to these market conditions, call it a recession or not, or whatever's going on, but during these times is when we really need to remain smart and lean. And, we've mentioned before that we have funds committed for our growth project, and our business strategy really does accommodate to more of a steady burn rate without being over-leveraged. The industry dynamics, especially in the lithium-ion battery industry, really changing, and we have an opportunity to remain flexible as we de-risk our technology on a larger scale. But, in terms of company news, we had a press release this week where we reported on the delivery of NMC 811 cathode precursor, and this is to active collaborators around the globe, and they will look to independently analyze and test the material on the cell level, which we believe will be a great milestone in developing a circular solution. The samples were produced from lithium-ion battery waste on bench scale, and which we work to continue to do in parallel to the commissioning of our demonstration plant project. So there is continuous work being done. And I also like to address some listener questions that we got. For example, here I got asked, why is lithium not mentioned in the press release? And, I think I can kind of see that confusion. Like, lithium is recovered as well from our process, and we have reported on the production of lithium sulfate, hydroxide, and carbonate in the past with high recovery rates and purities. But I can see the confusion because given our press release, we have two product streams, one being the cathode precursor, which is a combination of nickel, manganese, and cobalt, and the other being lithium. And in this instance, collaborators were looking at analyzing the cathode precursor specifically. And then when it comes to, is there much black mass available to recycle, and could AMY's process, eliminate the need for recycling? Well, in terms of black mass, that's really produced from the mechanical pre-treatment of end-of-life lithium-ion batteries, and then that would be the input into the recycled hydrometallurgical process. So there is black mass feedstock available, and that will continue to grow with the EV industry. But black mass is an input into our process, and that does what we focus on from that black mass is the recovery of lithium, and as well as the cathode precursor. And then just as a closing thought, it has been great traveling again and making more personal connections across the lithium-ion battery supply chain. And I will be traveling for business again next week. Therefore, I will be doing podcasts on an as-needed basis. So please send your questions to us, and we will address them when the opportunity comes up.
Larry, any other thoughts that you'd like to add?
Well, I'd just like to say that everything's getting better on this side. We had a directors meeting. We're going to stay the course and focus on producing cathode precursors,
And that was the initial idea. We raised all that money. Based on that, we got a good bank account, and we're not going to go, unfortunately, it won't be sidetracking and going into manganese. I know that can eat a lot of money very quickly. So I think we got a winning combination on our hands. Let's stick with the winners and keep moving ahead.
Larry, Zarko, thank you so much for chatting with us.
Thank you, Jim.
You're welcome.
I've been speaking with American Manganese CEO and President Larry Reaugh and American Manganese Chief Technical Officer Zarko Meseldzija. I'm Jim Goddard. Our conversation took place on May 20th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.